Right. So Ajit, nice to have you back on the channel after a while. How have you been observing things, sitting there in Europe for last couple of weeks and months? India kind of has started lagging once again, but there is very strange tug of war happening between the bulls and the bears. Bears saying that things are not good on ground, and are asking for a textbook kind of correction, which we saw last time round. But market is resilient. Look at the numbers, look at GST collections and flows overall. Which way could you see things or the tide turn in your view?
So, good to see you, Ajay. I think last time we met was June of last year. And just to remind you, like I was actually traveling in Europe at the time when COVID broke out. I was marketing what in India is called our ESG India ESG fund, and here in Europe and the US we call it the India Responsible Returns Fund. So I was out here talking about that marketing ESG and why it's important to look at that. And then COVID broke, so I actually came back to India on March 8th of 2020. And I was in quarantine for 2 weeks. And then, of course, we had the national lockdown from March 24th. And then my children who were that time studying in Europe, they had holidays. So I kind of, came back to see them on a rescue flight of April 9th. And I've not touched Indian soil since then. I've been shuttling between Switzerland, where my children are, and UK, where I'd actually left my bags and my files and my marketing material for the last year. But clearly, what we have seen is that in Europe, in particular, we had Brexit of the UK and the split between UK and Europe, and you've seen a dramatic improvement in the way the UK has handled COVID, and a failure, like India, the way Europe has handled COVID. So, sitting here watching this argument every day on Brexit and how it was bad for the UK to leave, the UK actually feels now pretty happy that they've left the Europe, because the Europe decision making was bureaucratic, it was slow, it was messy, and you can see it in their vaccination rates, right? Whereas in the UK, Mr. Boris Johnson, who himself contracted COVID, and after saying COVID was nothing and useless, once he got it and he had a near death experience by being on ventilators and being on oxygen and stuff like that for 4 or 5 days, when he recovered, he was very clear that he must get the vaccinations ready, as was the US. I mean, President Donald Trump, for all his faults, the US did keep a $15 billion war chest to fund COVID vaccine creation. And they did that since June, July of last year. So, and of course, Biden is now benefiting, as is the American population, from that move in America. So America and the UK have actually got vaccination right in terms of large economies, forgetting Israel and other smaller countries. They've understood that in addition to distancing, in addition to washing hands, in addition to masks, you need to have people vaccinated to reduce the chance of them going to hospital and eventually dying. So that's what they've done while they kept us under lockdown in Europe. And over the last 1 year, I've spent about 104 days in lockdown and quarantine and transit between airports. So I've spent nearly 3 months, more than 3 months of my time just locked down, following the rules and procedures and processes in these countries. And and I think they'll come out trumps. They'll do extremely well because of this. Whereas in India, when I was here talking to my cousins and my friends in India, my family in India, and my work colleagues, they were going out in December, January, while we were all locked down in horrible, depressing, frozen weather. And now we're seeing that there's not enough vaccination. So you're seeing the spurt in COVID cases, and you will see now the economic and social and individual cost of the fact that we're not well vaccinated while we are going out.
Do you see that, on the one hand, the argument is that the real economy led by SMEs and financials will actually see the brunt of this, however delayed it might be. The other hand, the argument is that market is a forward-looking animal and it is looking beyond 2 to 3 quarters. However brutal or insensitive that argument might be. What are your hypotheses, the way things could pan out?
No, I think people who say that markets look forward are absolutely right. But I'd like to clarify it in one sense, is that the markets reward the winners. And right from 2008, with the bankruptcy of Lehman, we've actually seen, while around the world we know there is growth within inequality. We know the poor have become poorer. We know the middle class around the world, including India, have become poorer. So we know those statistics, and yet stock markets and financial markets have gone up, because the stock market is really a gauge of winners, right? If you have a bad company in the index, what do the index people do? They remove the losers. So there is no Century Textile, there is no Satyam. They've been removed, and what remains are the winners, right? So you're
Right.
rewarding the winners, and the indices and markets in general really just reflect the winners. They don't really care about the losers. The losers can cry and be sort of cry babies, as someone said recently. But it's about winners. So yes, I mean, the markets will give opportunities for you to rearrange your portfolio and to figure out who the next winners are. So even if you take the time from when Prime Minister Modi won his first term in May 2014, the winners have been Netflix and Apple and Microsoft and Amazon, Alphabet, Google. But the losers have also existed. And the thing is, you don't really want to own the losers. You want to reorient your portfolio towards the winners. So the market was right by
Right.
reorienting itself towards those entities or those companies who will win in a post-Lehman world, and those companies who will win in a post-COVID world. But that doesn't mean society is better off. That's a separate
That's
discussion.
true. Well, that's correct. I would not go in that direction. You know, just for the viewers of Business News Channel, Jeet. But at the same time, you're somebody who compares and analyzes different markets and different economies all over the world. Another argument which seemed to have gotten some risk back on the table for emerging markets like India is the way US is resolving to pump prime the economy, put in real money at work, be it infrastructure, rebuilding the economy. And if America goes whole hog on growth like that, not just handing over money to citizens, but putting real money at work in real assets and gross capital formation, then wouldn't investor money globally also start chasing America once again? Last 10 years clearly belong to developed markets, and India and emerging markets underperform. Is that a risk too?
Yes, I mean, a lot has happened in the last sort of, again, I'm going back to the time when Modi won, because that, from an Indian perspective, is when individual investors came back into mutual funds in a big way, with a lot of faith in Mr. Modi and his policies, and of course, in where markets can give you in terms of returns. So if you look again, going back to 2014 May, clearly the developed markets have far outperformed the Indian markets. I think the developed world, the MSCI World Index, gave you a return of some 12% plus in US dollar terms. And the Indian indices compounded gave you 8%. So we certainly did worse than the developed world. And that was for a different reason. One is, of course, we lost about 3.5% each year in just the FX rate between the rupee and the dollar. So we lost 3.5% of that. If we had not lost that on a like rupee to dollar, we'd be about the same. But if you take just dollar, we did lose out. So, but what has happened between 2016, 17 and today is that you've got a world that is sort of saying, let me worry about my own residents first, right? So if you go back to Trump, he called it making America great again. If you look at it in the Eurozone, they're trying to figure out how do you get unemployment low in this part of the world, given what happened after Lehman and the high unemployment among the youth in Spain, in Italy, in Greece, and Portugal. So that still needs to be cleansed out and worked on. And the only way was to create, in some extent, tariff barriers or make more investments in your home economy. So, COVID, of course, has upset a lot of that, because if you look at every testing kit that all of us are using in Europe or India and America, it's all made in China. So, ironically, although many people call this the China virus and that China created it and all that stuff, China is actually the biggest beneficiary in some sense of a post-COVID world in trade. So they've got a nice trade surplus going. They've got a good economy, and the rest of the world is still trying to figure out how do they get their own economies better. But to your point, as America and Europe begin to invest in their own infrastructure and in their own economies, it should attract more capital and more faith and more hope in the developed world. And it's likely that you'll see, in my view, better stock market returns in the developed world as opposed to the developing world, which has to deal with the problems of COVID, which does not have the ability, like the European Central Bank has and the Fed has, to issue bonds at 0% interest or negative interest. We don't have that ability in the developing world, including India. So I'm more skeptical when people say that emerging markets will see the flows. I don't think that may necessarily work out. I think a lot of the flows will actually remain in the developed world, but some flows will certainly come to emerging markets because there's so much money being printed by all the central bankers in the world.
Right. Ajit, how are you analyzing the Indian markets in terms of the way corporate earnings are panning out, the way smart businesses across sectors and across market caps are navigating this crisis, and the kind of outlook which they are sharing with the investor community each conference call? We've been almost 3 quarters in the middle of this
Mhm.
pandemic, and things are looking upward if you choose to look beyond 2 3 quarters. From that side, what are your thoughts?
So 12 months ago, I wrote an article based on the Equity Master, Equity Master database of companies, that less than 5% of companies which are covered by Equity Master's database had more than 6 months of cash on hand. I.e., if the pandemic and the lockdown had carried on, it went on for 4 months in India, the lockdown. But if the lockdown had carried on for 2 more months, many of those companies would have run out of cash. They would have cash in the bank to pay their salaries of their staff. So, clearly, many of the companies were in a fragile, risky mode in terms of sustaining their business potential and keeping the factory going, or paying the rent, or paying the taxes, or paying the salaries while there was no revenues. So luckily, we came out of lockdown from June, July of 2020, and you've seen this tremendous run up in pent up demand and consumption since then across the sector. But keep in mind that there will be losers, right? What I said before. You between GST, between demonetization and COVID, you've got this movement towards the organized sector. So the organized sector will see growth, whether it's shampoos, whether it's milk chocolates, or whether it's biscuits, or anything. You take the product, there'll be more purchases from the organized sector, which tend to be the listed companies. So there will be growth, ironically, within the listed companies in top line, and presumably also in bottom line, at the cost of the small scale unorganized sector. So that's what we've seen post GST, and that's what we'll continue to see because of COVID. So yes, one would be more optimistic in general on earnings of listed companies, because they will be beneficiaries in this shift in market share from purchasing from small unlisted weak players who may have even shut down their businesses, and then you only got the larger companies to effectively deal with and purchase goods from. So there
Sure.
will be growth in earnings for sure because of that.
Right. Ajit, you have done a lot of work on ESG. In the last 12 months that we spoke, there's a lot of developments here in India as well. Many companies are talking this language. Of course, investor community, more mutual funds have launched their ESG funds.
Mhm.
The jury is out. How are they different from existing funds of theirs? But still, this is something which is catching the fancy of investors. Interestingly, a lot of transactions are happening on the corporate side, where companies are intentionally restructuring their businesses in the favor of moving towards ESG. Just like JSPL recently sold off their power plant to the promoters, that they wanted to make the remaining company JSPL a pure play steel company and ESG compliant. And similar kind of reports are coming from elsewhere. What are your thoughts the way this is taking off, and how is your own fund catching traction there?
Yeah. So ESG is a very, very new concept, and will have a lot of queries and question marks going forward. But conceptually, Quantum as a company since 1996, so that's 25 years ago, we started something called the integrity screen. And that was immediately after I broke off from my joint venture with Jardine Fleming Quantum in the earlier days. And one thing I learned in that joint venture was that governance mattered a lot to me and mattered a lot less to the people that I had partnered with. So I left that and I made sure that when Quantum was in its new avatar, we built this integrity screen, which really was about governance. So, whether it was a Reliance, an SR, a Vedanta, these are shares we have not held in the Quantum Value Fund since we've created that value product in 1996. And of course, we launched it on the AMC platform as a quantum long-term equity value fund. So we've not owned any of these shares because we had queries about their governance, about their treatment of minority shareholders, and in some cases about things like polluting the water or polluting the air. But it was mostly about governance part of minority shareholders. Around 2013-14, we recognized and learned more about things like greenhouse gas emissions. We learned about carbon dioxide. We learned about pollution more. And we integrated that into a more overreaching ESG database. So rather than building our own database, we reached out to a few global suppliers of data, and they're all very well known names. And we asked them for their reports on companies which we knew had failed our internal test. And when we got those sample reports, the companies that had failed our test were given glowing numbers and glowing ratings by these external global agencies. So we said, you know what, that's not it. We'll build our own database. So 2014, we started the effort of building our own ESG database on our own criteria. Now, beauty and ESG lie in the eyes of the beholder. There is no standardized metric for many of these things, but
Correct.
we do know certain things. We know carbon emissions are bad, GHG emissions are bad. There are certain metrics we know. What is good or bad will be debatable for a long time. So we
Right.
built the ESG database, and from that, we launched the Quantum India ESG Fund in July 2019. So we did not take an existing fund and relabel it. We actually took a process that we had and chose portfolio is chosen entirely on ESG scores. We don't care about the PE ratio. We don't care about the price to book ratio. We don't care about price to cash flow. It's nothing about valuation metrics, unlike the quantum value fund. So we have the value fund where valuation metrics are important and the minimum ESG score is required. And in the India ESG fund, we have only the ESG score, and we have to make sure that the company is financially secure, that it won't go bankrupt, but we don't care about the PE ratio. So two very different approaches to using the database and the style of investing. And it's done exceedingly well. It's done better than the value fund, actually, over the last 2 years. So we believe that that product will attract a fair amount of international clients. And we hope over time, as Indian retail investors recognize the power of ESG investing. And the thesis is simple, that if you do good, you will end up having good results and you'll have good returns. And the ESG score kind of tries to tell you whether you're a good company or a not so good company. It's really as simple as that.
Right.
So 2 years
So,
is done quite well.
Ajit, lastly, I would like to understand from you, there was a very long patch of performance which favored the growth. In fact, people had forgotten value even existed because of a new
That's right.
generation of investors coming in, the 20, 30 something Robin Hooders, Game Stoppers, and they thought the entire environment suddenly became as if making money in markets is very easy. And now, of course, commentary coming from Mr. Buffett, and there was a correction which happened, and things are not that easy actually, but value has started outperforming and value has come back in style. What are your thoughts on this value versus growth and this new generation which doesn't really want to dig their hands or make their hands dirty but expect great returns in the market?
So, there are a lot of ways to approach nirvana. There are many religions that take you to God, as I always say, in nirvana. And there are many styles of asset management or investment management that get you to your returns. The one that I have taken personally in my life and I adhere to is value. I'm a value investor. But on a mutual fund platform, we have an index fund, we have the value fund, and we have the ESG fund. And I'm also investing in the ESG fund. I've not invested in the index fund at all. So, but I am investing my own capital in the value fund and in the ESG fund. So, and we built another product called the Quantum Equity Fund of Funds, where we said, look, there are other fund houses out there who follow different styles of management, large cap, mid cap, small cap, growth, whatever. And let's pick six of those best ones and give you a portfolio. So if you are an investor with the quantum mutual fund complex, literally buy a combination of the quantum equity fund of funds and the value fund and the ESG fund. You buy these three funds from us in a ratio where you give 80 rupees, for example, to the equity, to the value fund, 80 rupees to the equity fund of funds. You give 10 to the value fund and 10 to ESG. You've built your basket, right? But getting back to the question about value versus growth, 2018-19 was a terrible time for value. And I think I mentioned that last time too on the talk with you, that, but every time there is hype in the market, value by definition will not do well. When the market's correct, or when there's a crash, or when there's rationality, by definition, value will do better. So if you look at the track record of the value fund, of the quantum long-term equity value fund, 2018-19 are pathetic. I mean, really poor. And they were because of the environment. 2020 January, we were trailing the index. By March, the markets collapsed. And the run up from March, April till now, the long term value fund has done exceedingly well. And so, from January 2020 till May, till now, till May 3rd, May 4th, we've actually seen value do better than the index, despite the fact that we do not own Reliance, which has been an absolute star. And we don't own it in the portfolio for, like I said, reasons of ESG scores and reasons of governance in the value fund. Despite that, it's done exceedingly well. So you will find these cycles. And it's very difficult for an investor to figure out, should they be in value, should they be in growth, what they should do. Our answer is, you know what, we built a solution for you. Just sprinkle your money in those three and you'll do well. There is, as you know, a lot of movement towards ETFs and indices. I
Correct.
believe, and I'm saying this a quote from John Bogle. John Bogle is a founder of Vanguard. In February 2010, I sent him an email showing him how the Indian indices are computed. And John Bogle has sent an email to me in February 2010 saying, you know what, if I would never buy an index fund in India. This is John Bogle, the founder of Vanguard and the father of indexing. So when we see SEBI as a regulator has come out with a rule recently, a few days ago, talking about certain sort of compensation rules that
Correct.
apply. And I think it's a very, very misguided circular in my view. But they've come out with this circular and they have exempt index funds and ETFs from it. I have no idea why a regulator would
Skin in the
prefer
game.
one style of investing compared to another style of investing, active management. There are various ways to limit fraud in the system. SEBI
Mhm.
has got high net worth, SEBI has got trustees, insider trading, multiple reports. And after all of this, they're now trying to control it by saying, hey, if you are giving an active manager money, then that active fund manager and his whole team has to give compensation, has to be restricted, whereas ETFs and indices are free.
Exempt of
John
it.
Bogle has questioned the ETFs and indices in India. And if, I mean, he's no longer alive, very sadly, but
Correct.
they should send the way indices are constructed and they'll realize it's not so great. We have an index fund. When the moment is right, we will certainly flag it to our investors. We've got a 10-year, 12-year track record in the index fund. It's there, but we don't really believe it is the future for today. And investors should stop worrying about value versus growth, and they should sprinkle their asset among 6 to 8 to 10 equity funds, and they'll be fine.
Right. All right, Ajit, we'll let you go on that one. Thanks so much for joining us today.
Thank you so much.